Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 12th of June, 2026, and joining Lee to pose some questions on the financial market themes for the week ahead is Abdul-Ahad Lockhart, Currency Analyst at MUFG. This podcast is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Lee.
Hi, Abdul-Ahad.
So there's a busy week of central bank updates for the week ahead. What are your thoughts going forward?
Yeah, like you said, most of the major central banks are meeting in the week ahead, including the Fed, BOJ, and Bank of England. For us, the main policy meeting for FX market performance will be the Fed's policy update. Going into that meeting, we have seen positive economic data surprises, both for activity and inflation, and that is putting more pressure on the Fed to shift in a more hawkish policy direction. And we've definitely seen the US rate market moving to price in more rate hikes for the Fed, and that's been putting upward pressure on short-term US yields, and that has then spilled over into the FX market and lifted the dollar back towards the recent highs against most major currencies. And next week's Fed meeting is going to be crucial in determining whether this upward trend for US rates and the dollar will continue going forward. We would say it's potentially a pivotal meeting for the outlook for Fed policy and the dollar, in that it's going to be the first Fed meeting under new Fed Chair Kevin Warsh. And until now, we haven't really heard much from Kevin Warsh in terms of his thoughts on the outlook for monetary policy, given the backdrop of the energy price shock that's currently taking place. It's been our view, and I think a pretty consensus view amongst market participants, that Kevin Warsh is likely to lean on the more dovish side, putting more emphasis on disinflation risk from the stronger productivity growth that we've seen recently in the US economy, which further down the line could allow the Fed to resume rate cuts. Admittedly, in the very near term, given the pickup in energy prices that we've seen since the Middle East conflict started, it's obviously going to be very difficult for the Fed to cut rates now. And as we saw as well earlier this month, that we had the third consecutive month of much stronger employment growth in the US. So those kind of downside risks to the labor market, which had kind of justified the cuts last year, obviously no longer is the case. So I think it definitely, Kevin Warsh's first meeting as Fed chair, he's definitely not going to be able to kind of lay the ground for rate cuts going forward. I think at best he's going to try to signal that the Fed is willing to look through the pickup in inflation in the near term from higher energy prices, in the hope that if energy prices start to peak out in the coming months, then potentially later this year or more in 2027, the Fed could at that point look to resume rate cuts. So that's our kind of view on what we're expecting from Warsh. And I think for that reason, we're still kind of holding on to the view that we could see the dollar weaken again later this year, heading into 2027. But that view is definitely going to be tested in the week ahead. If we do see any indications from Kevin Warsh that he's uncomfortable about the upside risks to inflation in the near term, and that he's considering possibility of responding to that by hiking rates, then yeah, I think that would definitely open the door for the potential for the dollar to strengthen further from here. It'd be interesting as well to hear some of your own thoughts, Abdul-Ahad. I know you've been looking at how the dollar and US rates have responded when there has been changes in Fed chairs in the past.
Yeah, thanks, Lee. So looking back through history, market reactions to new Fed chairs have been highly cycle dependent. Each chair inherits a distinct macro and policy backdrop. meaning outcomes are not uniform across episodes. Market expectations depend on whether the incoming chair signals a change in policy, as well as a need to tackle economic conditions such as elevated inflation. The perceived degree of political influence also plays a key role in shaping market pricing. So to compare macro regimes, we constructed a macro regime scorecard across 3 key pillars: inflation, labor, and growth. According to our macro regime scorecard, Warsh inherits a relatively muted macro backdrop with inflation, labor, and growth broadly balanced. This provides greater flexibility for a gradual and measured policy approach. However, the risk profile remains asymmetric. External shocks, particularly from events in the Middle East, could disrupt the stability and rapidly shift the macro backdrop through higher inflation, rising unemployment, and weak growth. So in terms of market reaction around the first Fed chair press conference, front end rates continue to lead. Yields tend to move immediately as markets rapidly reprice the expected policy path. In contrast, FX reacts more gradually, where DXY adjustments are less front-loaded and tend to evolve over subsequent sessions, reflecting ongoing reassessments of the policy outlook. Overall, dollar moves are driven by shifts in expected policy rather than the initial announcement itself, signaling that FX responds to an evolving policy path rather than the event shock.
That's interesting to hear. There's also an important BOJ policy meeting as well, worth kind of highlighting in the week ahead. I think going into that meeting, we have heard in a number of media reports in Japan that the BOJ is planning to raise rates again by 25 basis points in the week ahead. So we do think it's kind of largely priced in now that we'll see a rate hike from the BOJ in the week ahead. At the same time, we've also heard from the BOJ that they're also considering potentially pausing their quantitative tightening program from fiscal year 2027. For us, in terms of the FX market performance, I think if the BOJ does hike rates this week, we don't think that on its own would be sufficient to trigger a reversal of yen weakness that we've seen recently. Like I say, the Japanese rate market is already pretty much fully pricing in a hike from the BOJ. And even looking at the updated forward guidance, to us, it seems most likely that they'll kind of stick to the path of gradual rate hikes going forward every 6 months. So we don't think they'll hike again until later this year. So I don't think that change in policy next week from the BOJ will be sufficient to strengthen the yen on its own. If the yen is to strengthen, I think it would need to be supported by other favorable developments in the fundamental factors. So one potential positive for the yen would be reports that we've seen at the end of this week suggesting that the US and Iran are close to finalizing a deal to end the conflict and reopen the Strait of Hormuz. That deal potentially could be announced as early as this weekend. Certainly if we were to start next week with a deal in place and evidence of a pickup in terms of oil and energy flowing through the Strait of Hormuz, I think that would trigger a further move lower in energy prices. And if that did materialize, I think that then would definitely help create a more favorable backdrop for the yen to rebound from these weak levels. So that wraps up today's podcast. Thanks again, everyone, for listening, and have a good week ahead.
Thank you for listening to the MUFG Global Markets podcast. Subscribe to keep up to date with the latest insights from the Global Markets Research team. For further information, please contact your MUFG sales representative.